right? So it's the WACC. So we're going to spend a week and a half talking about this thing. Today we'll go back to the basics you guys have had before. We'll probably do it in depth a bit more than you had in 3333. On Thursday, we'll come back. I'm going to skip a number of slides today. I'm going to kind of do it a bit different than what I have up in the slides. We'll get all the basic math down. And then on Thursday, we'll come back and look at some practical estimation issues. Like, where do you actually get the real numbers from, right? If you were really putting a WACC together for a firm, how would you do it? Where would you start? Where would you get the data from? What are the various alternatives and what kinds of issues arise? So we'll talk about that. And then next Tuesday, we'll talk about applying this concept of the cost of capital to individual projects, to company divisions, things of that nature, which is the way it should always be done. So we'll kind of narrow it down for a project-specific cost of capital, a division-specific cost of capital. What do I mean by division? Well, General Electric has multiple divisions inside their corporate firm. They've got the old lighting division. It's still around. It's like a tiny, tiny fraction of the company. But GE Lighting, they've got a jet aircraft or jet engine division. They've got another that does power systems for utility companies. They used to have a financial arm, GE Capital. They had a division that had oil and gas field equipment services. So all these divisions, they have different levels of risk, and as a result, they have different cost of capital per division. So in GE, whoever's in charge of GE overall needs to understand that each of those divisions has a different, what we call hurdle, a different cost of capital they have. So like if I'm the lighting division, maybe I'm a lower risk than the jet aircraft division, and I don't have to earn as high a return because I'm lower risk, right? So we'll see that next Tuesday. Today we're going to focus on just the cost of capital as you guys know it. We're probably going to pick up some problems that are a bit further advanced. Okay, so we'll pick up the basics and kind of work from there. Just to kind of, before we do that, what all we're doing in this set of chapters, we're getting the discount rate out of the way. The cost of capital is our discount rate. And it's going to reflect the risk of what we're looking at. The cost of capital always reflects the riskiness of the investment, so keep that in mind. Higher risk investments should have a higher discount rate, a higher cost of capital, and vice versa for lower risk projects. And then we're going to look at the projects, right? We're going to look at capital budgeting, decision criteria, net present value, internal rate of return, all that stuff. And then a whole bunch of other specialized decision criteria that are used in certain situations, right? So that's where we're going to kind of separate ourselves from what you had in 3333 finance. Then we're going to look at estimating the actual cash flows in a capital budgeting project. And then real options. Now, remember I told you guys in the corporate valuation stuff, there's different ways to value equity. There's the discounted dividend approach. There's the free cash flow, the corporate valuation approach. There's also, we could use option models to do it. Well, we're going to use those option models not to value the firm, but to value a project, right? So we'll see how options analysis comes in. Okay, so that kind of gives us an idea of what we're looking at in here. And, you know, outside the discount rate, the other three chapters are all looking at capital budgeting projects, right? Investments that a firm has in front of it that they want to evaluate. So that's really what we're focusing on in here. Okay, so cost of capital. Why is this thing important? Let's go to our corporate valuation model. The value of my firm should be my cash flows discounted at appropriate cost of capital, right? So, and then if I want to give my stock price, take out any debt, preferred stock, divide by number of shares, that's my corporate valuation model. So, if we have a higher cost of capital, everything else remains the same, we're going to have a lower firm value and a lower stock price, right? So if the WACC gets larger, firm value gets smaller, stock price gets smaller. And likewise, if the WACC is smaller, it's going to be the other way around, right? Then firm value and stock prices should be higher, all else equal. by the way, I wish I hadn't shut that thing. Let me bring that back up real quick. There are going to be some concepts you'll hear in this chapter. You're going to hear again in about a month and a half, 2 months from now. When we get back in here in the last part of the course, we're talking about capital structure, the mix of debt and equity in a firm. That mix of debt and equity has an impact on the cost of capital. So every now and then I may allude to things that affect the cost of capital while we're in this chapter. That's really not the focus in here, but I may do it anyway at times because we're on the topic, but we'll talk more about that aspect of it at that later date, right towards the end. Like what makes the cost of capital high? What might make it lower for some firms and higher for other firms? We'll see that later on. Right? So we've seen that. We've used this in our corporate valuation model. We've also used it in our EVA formula, right? Economic value added. So let's think about, so we probably have an idea of when to use this number. We want to use the WACC when we're looking at the overall firm, so the whole firm, right? The big picture number. If you're looking at the entire firm, you want to value it or you want to assess the firm's return versus the cost of generating that return, EVA, use the cost of capital to do it. When we look at the cost of capital, we need to figure out what are all the different sources of capital that the firm can raise or that they utilize. So what do I mean by capital? What do I mean by capital? What would be a source of capital every firm's going to use?
Banks.
Not banks. Close.
Common
Equity, right? So equity, stock, right? In fact, I don't have to have any debt, but I'm going to have equity, my own contribution. So equity is going to be one form of capital. Investors require a rate of return, or they wouldn't put their money in. Doesn't mean they'll get it, but they anticipate a certain rate of return on their investment. And if they don't think they're going to get it, they're going to move their money elsewhere. So equity investors have a minimum required return that they hope they're going to earn on their investment. And that equity and that rate of return are part of the cost of capital. Who else? You said bank loans, right? So debt. So debt is another component of the cost of capital. Not all firms, but a lot of firms borrow money, and that's a source of funding, right? That's a source of financial capital. And so creditors have a required return, or if they don't think they're going to get it, they're not going to lend to you. So we have to be aware of what return they expect. If we have preferred stock, very few firms have it, but for those few that do, we need to know how to incorporate preferred stock in. That's a third source of capital. Preferred shareholders have a required rate of return. Now, we have to earn an overall return that's sufficient to take care of all three of those groups, right? And that's the weighted average cost of capital. Let's see. A couple other things here. The cost of capital is it's going to have long-term sources of funding in it, because the cost of capital is, it's not the cost that we're going to use to go and figure out, do we need to borrow to finance inventory purchases? That's working capital management. We're looking at like long-term projects, so we need a long-term discount rate to see if they're worthwhile. We're looking at the value of the firm, that's long-term, so we need a long-term discount rate. So we're looking at long-term or permanent sources of funding. I'll talk more about that in a bit. Now, the last bullet point, the textbook does some in this chapter discussion about it, and we're going to talk more about that on Tuesday. But I'm going to try to make that very aware to you guys as we go through here. The last bullet point is really important. In finance, quite often, and this book does it, unfortunately, the WACC gets used as a discount rate for everything, and that's almost always inappropriate. If I want to know what discount rate to use for GE's electric division or lighting division, and they're less risky than GE as a whole, I've got to use a different discount rate than the WACC. If their jet aircraft engine division of GE is riskier than GE overall, I've got to use a different discount rate for that. right? So I have to adjust my discount rate for the risk of what I'm looking at. If it's a high risk investment, I need a higher discount rate, and a low risk investment needs a lower discount rate. So that's what we talk about, a project or divisional cost to capital, is where you adjust the discount rate to reflect the riskiness of what you're looking at. That's always going to be something we need to be aware of that we're going to do. Okay, here's your basic WACC formula. You guys have seen this thing before. Weighted average cost of capital is the cost of debt, preferred stock, and common equity. That's the RD, RP, and RS. Weighted by our relative use of each. So as an example, if half of our financing is common equity, then WS is 0.5. And if 30% of our financing is debt, WD is 0.3. And if the remaining 20% of our financing is preferred stock, WP is 0.2, right? So we don't take the three costs and average them. We weight them according to how we use them. Things get used more, get a higher weight. The other thing that you've seen before, but we'll discuss it in here in a little bit, we have to adjust the cost of debt from a pre-tax, that's RD, to an after-tax. So we multiply it by 1 minus the tax rate. We'll see why we don't do that with equity or preferred stock, right? We only do that with debt. Now, real quick aside, if you've got all those numbers right there, we've got 2, 4, 6, 7 numbers. If you have those, it's a quick thing just to plug them in and work through the math, right? So we're not going to spend really our time working through that equation, but through pieces of the equation. So we're going to spend most of our time, right? Computing the cost of debt, computing the cost of equity, or the cost of preferred stock. That's where most of our time is going to be involved in this chapter. Okay, let's look at these a bit more here. Those components, in fact, what we're going to spend our time on today is the R's. Cost of debt, RD. The cost of preferred stock, RP. Yeah, right.
Are we going to have to figure out the weights too?
They'll be given.
Oh,
They'll be given
typically?
Well, let me back up. They could simply be outright given, or it may be I give you the underlying data where you compute them. I think that's what you're getting at.
Yeah.
We'll see that. It won't be today, but we'll see how those weights can be derived. It's fairly straightforward. That's what it is. So the R's, those individual, or what we call component cost. There's debt, or first off, back up. Every firm is going to have equity. So the one component that every firm is going to have is this RS. Okay? Lots of firms have debt, so they may have RD. And a handful of firms have preferred stock, RP. If they don't have it, that part's going to be 0 in the equation. So don't try to put a number in for everything. If a firm doesn't have preferred stock, it's 0. If they don't have debt, that's 0. Right? They'll all have common equity though. So you notice that there's a common word up there: cost of new debt, cost of new preferred stock, cost of new common stock. You see that? So here's one thing that's important. Firms like AT&T's been around for over 100 years. They've been financing their operations for that entire period of time. They still have some debt. They've got stock that was issued 100 plus years ago. They've got some debt that's been around for a while, probably not 100 years, but it's been around for a while on their balance sheet. Is that part of their cost of capital? No. You say, why not? Because their cost of capital should reflect what they would have to pay today if they entered capital markets right now and raised new capital. So what does that mean? AT&T already has some stock, but what would it cost them to issue new shares of stock? AT&T has some debt. What would it cost them to borrow more money? I don't know if AT&T has preferred stock, but what if they sold more shares of preferred stock? What would that cost them? What would investors require? Now, why don't we use the old stuff? Why do we use the new stuff that hasn't been issued yet? Because we need this to fund a project, right? Or we need it to value the firm, use the WACC as the discount rate in valuing the firm, but the firm is its value is future cash flows, not past cash flows. So discount rate should reflect current and future funding, not past funding, right? So the component costs that we're really interested in are the cost of raising capital we actually haven't raised yet, right? So what would it cost us if we went, it's kind of like, if you run a small business and you say, I think I need $1 million business loan, and you start calling several banks to get business loan rates, right? You're trying to get RD. That's what you're trying to do. You're trying to figure out what's the cost of debt for my business. And it may be a lot higher than what you've been paying in the past because interest rates have gone up. On the other hand, maybe you've gotten a lot bigger and you're less of a credit risk to a bank, so maybe your rate's gone down over what it had been because you're less of a credit risk, right? If we use old rates, we wouldn't be able to reflect that, but a current rate would be able to reflect those changes in both the firm and the marketplace. So we need to use current rates to reflect new funding instead of old funding. So that's one aspect. Look at common equity. Common equity's got something interesting. I've got two costs. New stock, retained earnings, reinvested profit. Retained earnings really means reinvesting profit. That belongs to whom? Shareholders, right? So if I'm running a firm and you guys own stock in the firm that I'm running, I'm the CEO, and I keep your money, I keep all the profits from this year, and I reinvest them back into the firm instead of doing what? What can I do with that money? Dividends or stock buybacks, right? I could give the cash to you. So lots of CEOs have this, if we have a chance, I've got a little bit of survey evidence or survey data on what CFOs, Chief Financial Officers, have said in surveys. And interestingly, and not good, a number of them have said that the cost of equity, of reinvested profit, is zero. Why do you think they'd say that? I generated, I'm running the firm that you guys own. You're the shareholders. We generated $100 million in profit last year. And I reinvest, let's say the profit's also cash flow, right? No difference. So I reinvested the whole thing. Why do you think they would say that that's zero cost to using that money?
Is it because it's just expected?
Kind of. It's because they already have it, right? They didn't have to go out and get this money. It's already there. So they, for whatever reason, apply a zero to it. But you guys have had a concept in economics that refutes that. You guys, when an eco professor talks about opportunity cost, right? So even though there's no explicit or direct cost to reinvesting profit, it belongs to you. The profit that I reinvest belongs to you guys, the shareholders. So if I take that money and I reinvest it, I have to be aware that from your perspective, I could have given it to you as a dividend, you could have reinvested it elsewhere, right? You have an opportunity cost. And as such, I need to measure that opportunity cost. And if I can't earn a return that's equal to or above that opportunity cost, I need to give you back the money. But if I can do better, then you should be happy with me keeping the money and reinvesting it on your behalf, right? So opportunity cost, there's an indirect cost of reinvesting profit, and it's basically an opportunity cost, right? It's what you, the investor, could have done with the money yourself. So reinvested profit isn't free. It does have a cost, but it's kind of more sublime, right? It's not a direct cost of raising these funds. Interestingly, debt and preferred stock and new common stock all have an opportunity cost as well. Those investors could do something else with their money. But they also have direct costs. They got cost of issuing these securities, which reinvested profit doesn't. So one thing that makes reinvested profit different from new stock or new preferred stock or new debt is if I issue this new stuff, I might have to pay somebody to help me issue it. Who helps companies issue securities? You guys know what I'm talking about? It's not a commercial bank, it's an investment bank, right? So like Goldman, is that what you said, Sergio?
Yeah.
Okay. So So like Goldman Sachs or J.P. Morgan, banks like that, you know, they do banking, but what they really, you know, like commercial banking, but what they really do is they engage in investment bank services, which basically means anything they can do under the sun to make money. And one thing they do is help companies issue financial securities, stock, bonds, and so forth. They're not altruistic, they're not free. They charge for this, right? And we'll see what influences the rates that they charge. Because the more they charge, the more expensive that cost of capital is going to be, right? So if you know, like, what kind of firm's going to have a high fee, what kind of firm's going to have a low fee charged by Goldman Sachs when they try to issue stock or bonds, that's going to determine which one's going to have a higher cost of capital, right? So we'll look at that when we go through this. That's kind of a brief overview. Today we're looking just at the WACC from the overall firm standpoint, right? The number for the firm. This number really has just a couple of purposes. When you as an investor are trying to determine what the overall firm, what the stock is worth, this is the number that you should be using, the WACC. Or you're management inside, you want to know if you're running the firm properly, the value drivers, so you're interested in the overall firm, need the overall WACC. Next week, when we want to look at projects, we're gonna change the WACC to a project-specific cost of capital. Okay, let's look at these components. We're going to start with debt, and we'll go to preferred stock, and then we'll go to equity. Okay, so cost of debt. So first thing, remember what we did back in that very first chapter with liabilities? I had you guys take every liability and either put an O operating or D for debt. Remember that? If you were to go through a company's, the liability section of a company's balance sheet, and you did the same thing again, then everything you put a D beside is going to be part of our debt and our cost of capital formula. So what does that mean? It means you could have short term, like a notes payable. Remember that? That was a piece of debt, that current liability. So that's part of your cost of capital. You could have long-term debt, like long-term bonds or mortgages, things like that. That's part of your cost of capital as well. Remember I said, in fact, let's do this real quick, just to remind myself more than anything. We said that it's either debt or it's operating liability. We put an O. In debt, we said, what were the keywords? We had debt, we had loan, mortgage. What were some of the other keywords that we had up here for this? You guys remember? What was it? Bond? Yeah.
Yeah.
Say that? Lease. And note also, right? So, no, there may have been another one, I cannot remember, but I know we had those 6 right there. We're not going to see this in this chapter. The chapter won't even bring it up, but leases are forms of debt. So if a company leases some of their property, that's going to affect their cost of capital. Right, the textbook does have a chapter on leasing. They show a way to compute the cost of leasing. And if a company actually did lease, we need that cost of leasing included in here. It may be different than the cost of debt, so we might have multiple costs of debt. One for like long-term debt, one for short-term debt, one for leases. So I'm not going to do this to you guys, but just kind of as an aside note, just because our cost of capital looks like this, are you going to have one RD? And here we will. But in reality, could you have more than one cost of debt? Yes. Short-term debt typically is less expensive than long-term debt, upward sloping yield curve. And so you might have a short-term debt cost, a long-term debt cost, a lease cost. So you could have 3 or even more costs of debt in here, right? So keep that in mind. Let's see. Cost of debt we're interested in is the what's called the new or the marginal cost of debt. We need this on an after-tax basis. So let's see. basically, the pre-tax cost is the interest that would be paid on brand-new debt that's issued. So that would be the yield on a bond. All right, so a bond has a yield or an interest rate of 10%. That's the pre-tax cost of the firm. If the firm has a 26% interest rate, then that means they're going to save in lower taxes. So we get to reduce the cost of debt because of the tax savings. Let me show you that real quick. Let's take a couple of firms here. Let's give them each $1,000 of EBIT. And let's have some interest. Let's say that we've got, let's put this up here. I should give myself some room. Debt. Let's say that we've got $4,000 of debt in this first firm and no debt in the second firm here. And our interest rate's 10%. So 4,000 at 10%. That's going to lead to $400 of interest. And then for the second firm, there's no debt, so there's no interest right there. EBT, earnings before tax, PTI, pre-tax income, whatever you want to call the next line, it's going to be our taxable income. So just the difference here. And then we take out our taxes. Let's just say the rate's 40%. Textbook seems to use that a lot, so let's use 40% here. Or no, let's use the 26 we've got right there, sorry. Let's use that 26. All right, so we've got 26%. So if I take 26% out of the 600, that's going to be 156 in taxes coming out. So my net income will be $444. And over here, we're taking out 260. So we get 740. We're gonna come back and do a few more things with this in a bit. But let's see here. Let's look at this line right here. So we paid $400. So 10% on $4,000 of debt meant interest of $400. Now, if we compare these two, like the firm with debt, the firm with no debt, we can look at the difference right here and see how much we saved. We saved $94. No, that's not right, is it? 104. We saved $104. Right, lower taxes. So this firm over here has a tax bill that is $104 less than this firm here. And the only thing that made them different was this firm has some debt. So interest minus our tax savings, 104, gives us our net cost, which is $296. If we take the 296, we had $4,000 of debt. That's 7.4%. So what we did was we had a pre-tax cost of 10%. That's what we paid to our bondholders, our creditors. We saved $2.6%. So minus our savings. And that is RD times T. And that gave us our net cost. So the reason why we adjust for taxes with cost of debt is when you go and you borrow money, that interest expense is a pre-tax expense. It lowers the company's tax bill. And that in essence makes the cost of debt lower than it otherwise would have been. So here's what's happening, kind of go through it again real quick. If I borrow this money, I'm running this firm here, and some of you guys are bondholders, I'm paying you $400 in interest in that $4,000 of debt. But then the IRS is basically giving me $104 back in lower taxes. So I'm still paying you $400 in interest, 10%. But because the government's basically giving a subsidy, it reduces my overall net cost. All right, so it's two pieces here. It's not that creditors are getting less interest or less money. It's that the government gives firms a subsidy for doing this in the way the tax code is structured. If suddenly overnight Congress said we're going to make interest expense and after-tax expense, that subsidy would be gone, and 10% interest would have a 10% total cost to the firm, right? So this is simply an artifact of how the tax code is structured, that we make this adjustment. Why don't we do the same adjustment for preferred stock or common equity? Because what you pay to those investors, the dividends, are paid after tax and not before tax. So, you know, I'm not saving any money on taxes when I issue common equity or I issue preferred stock. It doesn't save me any money. The pre-tax costs, after-tax costs are the same for those. Okay, so that kind of gets into a reason why we make this adjustment here, and how a 10% interest that you pay creditors actually has a lower cost to the firm because of the subsidy via the IRS. Now let's look at estimating this RD. Where did the 10% come from? Well, I'm going to give you the conceptual way first. This is something a little bit beyond what the book does, but let's talk about conceptually how this would be done. Then we'll look at how the book is doing it and talk about why there's a difference there. So, interest rates should all have a risk-free component plus any extra amount for risk. So in debt, the primary extra component for risk is a default premium. Risky corporate debt should have higher interest than a risk-free treasury because corporations can go default. Some corporations are riskier than others, so they have higher default premiums than others. So the default premium is going to vary with the firm according to their credit rating. A low credit rating, a high default premium. The risk-free rate is common to all these firms. So maybe we use the 10-year treasury rate. It's about 4.7% right now. But maybe our firm's pretty risky and we have to add another 3% default premium onto that. That would give us the rate of return we would expect to have to pay to creditors if we issue bonds. This in fact is the way that companies like Goldman Sachs and JP Morgan, if you took your firm to them and said we need to issue debt, what kind of rate would we pay? Now granted, you know, not going to a bank, we'll talk about that in a minute, but you go to JP Morgan or Goldman Sachs, what kind of rate would we pay right now if we went and issued $10 billion of bonds? And what Goldman Sachs or JP Morgan first would do is they'd say, okay, what's your credit rating right now from Standard & Poor's or whomever? Oh, you're a triple B, that's good. Would your credit rating drop if you issued more debt? They'd have to figure that out. Let's say they find, yeah, you would be a bit riskier, you'd be a double B. Then they'd find out how much extra interest do double B bonds pay above risk-free treasuries. That's the spread, that's the default premium. And they would take that and add it on to the risk-free rate now, and that would give us our rate that we would expect to have to pay. Right? That would ballpark it pretty close. So in theory, my cost of debt could go up from two things. It could go up because treasury rates go up, the risk-free rate, which they've been doing the past year and a half, right? So as the Feds raise interest rates, RD's gone up. Cost of capital's gone up in firms. It could also go up because firms are becoming less creditworthy. They're not as solid as they had been, and so default premiums can change. So those will both affect the cost of debt. And then we adjust an after-tax basis, and we also may have to pay Goldman Sachs or JP Morgan to help us issue. That's called flotation cost. So when you go and you bring on the help of an investment bank and they charge you, you're gonna have to pay that fee. What if you went to a bank instead of issued bonds? Same thing. Banks look at your credit rating before borrowing the money and after borrowing the money. They compute financial ratios to see if your credit rating would fall. And if it does, they'll charge you a higher rate. So they do the exact same thing that Goldman Sachs would do, trying to get your default premium. Okay, let's look at the way the book does this. It's the same basic thing, except they use, we could call it market data instead to solve this. So one way to do it is look at what other companies are currently paying in interest on brand new bonds recently issued. Like, what's the state of the market now, right? And so let's say that we want to issue 20-year bonds, right? So some pretty long-term bonds, and that right now there are some companies that have issued 20-year bonds, and they have roughly a 4.89% annual interest rate, a coupon. Our tax rate's 23.4%, and we've called up Goldman Sachs and they said we would charge you 1.64% flotation cost. That's our fee to help you issue these bonds. So how would this work out? So let's go through the math here. So first things first. This is like computing the value of a bond, or like computing the yield to maturity in the bond is the first step. So bonds tend to have $1,000 face value or future value. So I didn't have that up here, but that's common. The payment is the coupon rate times the face value. And if it's semi-annual, you've got to divide that by 2. N is the number of years times the number of coupons per year. Since this is annual, it's just going to be times 1, so 20. That's going to give us our PV. But look at what I did here. Or excuse me, when we plug in our PV, bonds are typically issued at par. But real quick, what's par? Now I said face value, right? 1,000. This is also called par value of a bond, right? The bond's par is its face value, the same term. But when we say a bond is issued at par, what does that mean? It means that its price is the same as its FV. These two numbers are the same. Not all bonds are issued that way, but most are. Most are issued at par. So PV and FV are the same. But then the PV, you reduce it by the amount that the investment bank charges for flotation cost. So I'm going to take out the 1.64% from this. So what's left is what the company receives net of flotation cost, net of the investment bank fees. Doesn't matter which. Make these two positive and this one negative, or vice versa. These two have to have the same sign. This one has to have the opposite sign. You solve out for the yield on the bond. We get 5.02%, and then that's RD. And then adjust it for our taxes, and that's the after-tax cost of debt right there. So this is a common way of doing this. Let's look at a couple of these real quick. Let's get off that. Let's go over to, not you, here. And let's look at let's look at 11.9 real quick. Let's work through that one. So, companies, 6% coupon rate, semi-annual bonds, $1,000 par value, that's the FV, mature in 30 years, sell at a price of $515.16. Tax rate's 24%. What is the after-tax cost of debt? So we got two things to do here. We've got to compute a pre-tax cost and then the after-tax cost. So let's work through this one. It's going to be slightly different than the problem on the slide. So this is 11.9. So first step is we want to get RD, right? We want to get the pre-tax cost. So let's see. FV is the par, 1,000. The payment is going to be 30. Right, if you're wondering, where did I get 30 from? It is the FV, 1,000. Let's don't put that right there. It's the FV, 1,000, times my coupon rate, which they're saying is 6%. So 6% of 1,000 divided by the number of payments per year. That's semi-annual, so that's going to be 2. So we're going to get 1,000 times 6%. That's $60, split into two $30 payments, each 6 months apart from each other. Let's see. N. Now they're saying this is a 30-year bond, but N is going to be 60. N isn't the number of years; it's the number of years times the number of payments per year. So 30 times 2. All right, this is semi-annual. Again, the one on the slide was annual coupon, so we didn't have to make these adjustments over here. Let's see, I want the PV. It says the price is $515.16, so that is the PV. We're going to put a negative on that. Remember, make the PV an opposite sign to the others. With that in hand, we're going to solve for I. And when we do, we're going to get 6%. Let me go back to the slide real quick here. Here was our slide, right? So we did everything. I didn't have to adjust the payment. I didn't have to adjust any because those were annual. And what I got was I 502. That was an annual rate of interest. That was the pre-tax cost. That was RD. This one isn't. So let me show you what's happening here. This is per 6 months. When you solve for I in the bond formula, the I is the same payment interval that your coupons are. So if your coupons are every 6 months, the I you get is for 6 months. So you've got to make an adjustment, multiply by your, I just put PPY, payments per year. It's 2 payments a year. So this is going to be our yield, 12%. That is our RD right there. Okay, so first, right here, second, right here. That's our pre-tax cost. It's 12%. And then third step, finally, the after-tax cost is RD, 1 minus T. So 12 times 1 minus our tax rate, which we're saying is 25%. So we're going to get 9% is after-tax cost. Let's do one more of these. This one didn't have one thing we had in the slide. This one didn't have flotation cost, right? So no charge from the investment bank. If it's not given, we just have to go with this, but quite often there's gonna be a fee. So let's pick up a problem that has that fee in it. Here we go, 1114, cost of debt with flotation. So let's do that one. So this is 1114. All right, so let's see. I'm going to issue new 20-year debt, par of 1,000. That's the FV, 9% coupon, paid annually. Okay, so let's set this up first. FV will be 1,000. Our payment will be our FV times our coupon, which is 9%. There's just one payment per year, so that's going to be $90 at the end of each year. N will simply be or 20. So this is a 20-year bond times one payment per year. We need our PV. So let's see. The issue price will be 1,000, the second row. They could have said the bond will be issued at par. Same thing, right? When you see bond issued at par, it means the price will be the FV. So $1,000. But then flotation cost will be 2%. So we're going to take out 2% from this. So 2% of 1,000 is $20. That's going to leave us with $980. We need to make that a negative, right? Opposite sign there. Let's compute I. Okay, so I get 9.223%. Now, look back over here, we're at this step, right? We're at this step right here. But now, that's annual coupon, so I multiply it by 1, I get the same number. So I'm done over here. So, times payments per year, 1, that gives me my yield of 9.223%, that's my RD. And then I can go and get the after-tax cost. We'll adjust out tax rate. And we'll get so there's the cost of the firm. So just kind of let's go back and look at the numbers real quick so they make sense. Whoever buys these bonds, what kind of return are they getting? What are the bond investors getting? What rate of return are the bond buyers getting on this bond? What do you think? If one of you bought this bond, what rate of return should you be getting?
9.2%.
That right there. What's the actual cost of the firm?
6.9.
That down right, that number right here. And the difference, about 2 1/3%. That's the tax subsidy from the IRS, right? So that's the difference. So this is what the bond investor gets. This is what it costs the firm. The difference is that tax savings that we went through. Look at this up here real quick. How much money did you guys as the bond investors, so bond buyers, how much did you have to pay for each bond?
980.
You have to pay 1,000. How much did I, the firm, get?
980.
I get 980. You guys pay 1,000. Who got the other 20?
The investment business.
the investment bank, Goldman Sachs, right? So you guys pay the par value, the 1,000, I get 980, the $20, that difference is the float, right? The fee. Sometimes it's called underwriting spread. That's what the investment bank takes per bond. So it doesn't affect what you guys, the bond buyers, pay, just like it doesn't affect your yield, or your yield's not affected by my after-tax cost, right? But it does change things from my perspective because I get less money because Goldman Sachs took some of those funds. So basically, Goldman Sachs sold the bonds for us, or for me, but then they took $20 out of each and gave me the remaining money instead. Okay, so that's kind of what the numbers mean up here for us, right? What you guys pay 1,000, what I get 980, the difference of 20 goes to Goldman Sachs, the investment bank. You guys are the bond buyers, you're getting the 9.22% return, but it only cost me 6.9. The difference is the tax savings, right, that the IRS is giving me. Okay, let's look at preferred stock real quick, and then we'll get back in here on Thursday. We'll look at common equity. All right, we'll spend the day on that and looking at some of the estimation issues. All right, preferred stock is it's going to be the simplest thing in the world to estimate, but let's come back to this slide in a bit, okay? Let me skip this slide real quick. Let's go down here. Preferred stock, when you value preferred stock, is the easiest formula in all of finance. It's perpetuity formula, right? Perpetuity is a perpetual annuity. It never ceases. So you get some cash flow, which is the dividend on the preferred stock. That's your cash flow as an investor. There's no maturity date because it lasts forever. Right? There's no maturity date on it. So all you've got is you've got a rate of return, you've got the cash flow, the dividend, and you've got the stock price. Those are the only three things. If you know the dividend and the stock price, you can solve out for the cost of preferred stock. So it's that simple. So let's look here. So here, I've got now I said it could be that simple. We can make it a bit more complex. So I need my dividend, needs to be in dollar format. Lots of preferred stock is quoted like a bond, interestingly enough. So instead of telling you you're going to get an $8 dividend, lots of times with preferred stock they say you get an 8% dividend. 8% of what? The stock price? No, 8% of, I could call it a fictitious par value. Why is it fictitious? Because unlike a bond, where ultimately the bond you get $90 every year for 20 years, and on the 20th year you'll also get the $1,000, right? You get 90, 90, 90, 90, 90, on out to the 19th year, and then the 20th year you'll get 90 plus 1,000. Okay? That's how the bond works. So these are all cash flows you'll get as a bond investor. What if you buy a share of preferred stock? Well, you're going to get $8 a year every year that the stock is out in the marketplace, but you'll never collect par value because it never matures. Par value is used for one thing with preferred stock. From a financial perspective, it's used to calculate the dividend. That's all it's used for. So here, $100 par, 8% dividend means the dividend's $8. If the stock would trade in the marketplace or be sold to investors at $95, and Goldman Sachs charges 3% to help issue this, then the market price adjusted for the float, $92.50. So now we've got our two components, 8 over $92.50, 8.86%. All right, so there could be a couple of little early calculations before doing this to get the dividend and to get the price net of float. And that's what we need in this thing. let's look at a problem real quick that does this. So let's go to 11.4, one at the very top. So cost preferred stock with flotation. So we've got $60 preferred, that's the par value. 6% dividend. So you can see what we're gonna have to do for the numerator. The dividend is going to be our par, 60 times the percent dividend, which is 6%. So the dividend is going to be $3.60 a share. And then it says similar stock is selling at, so we'll say the net price, this is the denominator, is going to be the market price. Says similar stock is trading at $70, and we want to adjust that for our float. And flotation cost to be 5%. So we get $66.50. So now, cost per preferred stock will be $3.60 over $66.50. And we get 5.3%. So there's our cost per preferred stock. Just like bonds, we get some problems that don't have float in them. So what do? Just leave the float out. Just use the market price. Some problems may give you the dividend already in dollars instead of telling you par and percent dividend. That work's already done. Let me show you a quick twist though. Here's something that could happen, because if you were actually estimating this, this is probably what would happen. Let's look at the problem we had up here real quick. How often do dividends usually get paid on the stock throughout a year?
Quarterly.
Every quarter, right? So every quarter you get a dividend. But that $8 right here, like 8% of par, that's how much you get paid in a year. So what would the issuer of that preferred stock do? They wouldn't pay you $8 at the end of the year. They'd pay you $2 each quarter, 4 times a year. 4 times 2 is $8. So if you went and actually looked at a stock and said, you know, I want to look at similar stock and try to estimate what my company would have to pay on you preferred stock by looking at outstanding preferred stock of other companies, you could do that. But companies pay dividends on a quarterly basis. You'd have to go back and add up the past 4 quarters of dividends, and that would be your annual dividend, and that's your numerator, right? So keep that in mind. Dividends are usually paid quarterly. We want the annual amount for this, right? So one way is just to add those past 12 months of dividends, and that's your annual amount that you get. Okay, a couple of other issues about preferred stock, and then we call it a day. We've got a few minutes early. Preferred stock is equity. Companies can't default on it, but interestingly enough, it's treated almost like debt. Companies that have preferred stock, that preferred stock has a credit rating applied to it, except the credit rating will be a little bit lower than what it is for the same company's debt. That's interesting. Why? Why do you guys think like some company like XYZ has some debt? Their debt has a AAA rating, that's the highest it can be. The preferred stock has a AA rating, one notch or a notch below that. Why would the preferred stock have a lower rating than their bonds?
Because they get paid first and then preferred stock.
Who gets paid first?
The creditors.
Bonds get paid before preferred stock. Because preferred stock gets paid is junior in claim to the debt, to the creditors, that means if something did happen, who's the one at most risk? Preferred shareholders. Because they have greater risk than the creditors, they have to have a higher rate of interest. And remember what we had up here conceptually? what should your rate be? It should be a risk-free rate plus a default spread, a default premium. So the default premium for preferred stock should be higher than it is for debt by the same company, because preferred shareholders get paid after all the creditors. So that means that their position's riskier. So when you look at a company, you should always see this. You should always see their cost of debt pre-tax is lower than their cost of preferred stock, always. So if I issue preferred stock, I know it's going to have a higher cost than my cost of debt. You might say, well, why would you issue preferred stock if it's going to be more expensive? I don't have to worry about default, right? Now keep that in mind. I can't default if I don't issue dividends on preferred stock, right? You can't be taken out of business if you don't pay dividends to shareholders. They simply won't like you anymore. They may sell their stock and run to another company, and that may collapse the value of your stock. It may not be to sell anymore. So there are implications, but you cannot go bankrupt because you don't pay preferred stock. You can go bankrupt because you don't pay your debt, right? So there are some different issues there. Still, preferred stock has a credit rating, just like debt does. It's going to be lower than the same company's debt because it gets paid after their debt does. Notice what else I have? I've got the cost is basically the dividend yield. And what's the dividend yield? The dividend yield is a company's dividend divided by its stock price. Do the same thing for preferred stock. So it's the dividend yield of preferred stock is the cost of preferred stock. Okay. On Thursday, we're getting here. We'll start with the cost of equity right here, and spend our entire day looking at that. Okay. So that's where we'll start